Welcome back to Money Talks US, China, and Beyond. I'm Chris Lee. If you caught our first episode, you probably already know we're going to dive into what I believe is the single most serious threat facing us today. Something that could very likely lead us into the most dangerous time in history. Okay, picture this. The Chinese Communist Party decides to invade Taiwan. The US and its allies step in, and bam! It escalated into a full-blown global war. The CCP hits back hard, dragging the US and everyone else into this massive, catastrophic conflict. It's a chilling possibility. And in this episode, we're gonna break it all down, what it means, how it could unfold, and what we need to do to prepare. Let's talk about money and how big events mess with our investments. There are two main things to keep an eye on, according to the incoming Treasury Secretary Scott Bessent. First, there's the probability. How likely is this one to happen? Then there's the severity. If it does happen, how much of an impact will it have? For better or worse? Now, in this episode, we're not going to sweat the probability, and we'll take up that next time. Instead, let's focus on severity. What if the CCP kicks off a war? What could that mean for the economy, the stock market, inflation, and most crucially, your wallet? Let's dive in. So how bad is it? Honestly, very, very bad. There's no sugarcoating this. If the CCP war scenario unfolds, the ripple effects on the global economy, markets, and your finances could be absolutely devastating. The economy could really take a beating here. We're talking about a near certain crash in the financial markets, where the stock market might tank by 50, 60, or even 70%. People will stop spending, consumer confidence would hit rock bottom, and the business might just freeze on investment. That could mean huge numbers of people losing their jobs. Ming Wu, a Taiwanese entrepreneur and CEO of Macronix, a Taiwan-based chip company, told NBC that he believes this kind of war could set the world back at least 20 years. And get this, two well-respected companies actually crunching the numbers. According to Bloomberg, a war between the CCP and the US could knock off 10% of the global economy. That's $10 trillion gone. This would dwarf the impacts of 2008-2009 financial crisis, the COVID-19 pandemic, or even the dot-com bubble. Makes the economic fallout from the Russia-Ukraine war a drop in the bucket. The US economy would suffer a little less than 7%, about $2 trillion. China would suffer more, 17% of the GDP, close to $3 trillion. Now listen to this. Rand Corporation, another big shot US think tank that advises the government, the allies, the big businesses, they've done some calculations too. They estimated that if there's a war between the CCP and the US, our economy could shrink by 5%. That's roughly $1.5 trillion, slightly less severe than the Bloomberg's prediction. But here's the kicker. China would get hit very harder, way harder, with an economic contraction of nearly 25%. So for the US, we're looking at a loss of 1.5 to just over $2 trillion in economy. It's a massive number, massive. But keep in mind, that's just the economy. What happens to the stock market could be even more, much more devastating. To give you some perspective, during the 2008 and 2009 financial crisis and the Great Recession, the US economy contracted by about 2.5 to 2.6% at its worst. That's only about half of what's being estimated for a war with the CCP. And remember, how the stock market tanked? The S&P 500 dropped by a whopping 55% at its lowest. After dot-com bubble burst, the economy only went down by less than 1 percentage point. But the overall market, S&P, lost close to 50%, while bubbly tech stock NASDAQ nosedived by 78%. $100 in your accounts became $25. During the 1930 Great Depression, the stock market lost 93%, almost completely wiped out. Given all that, it's pretty reasonable to think that if we are looking at a CCP-U.S. war scenario, the U.S. stock market might see fall somewhere between 50 and 70%, or even more. In dollar terms, a 50 to 70% decline could erase anywhere from 27 trillion to 38 trillion in wealth. It's going to totally wreck people's finances. Retirement funds could be cut in half or worse, and anyone with a lot in stocks might see years of savings just vanish. Folks might have to push back their retirement plans, rethink their lives, no more vacations, let's cook at home, honey. And don't forget about home values. They could tank in this scenario too, leaving a bunch of homeowners underwater, where you owe more on your mortgage to the bank than what your home is actually worth. We saw something similar back in 2008 when some areas where home prices dropped by 30 to 40%. Unemployment would go through the roof as business started slashing jobs, particularly those linked to the stock market or dependent on China. Consumer confidence, it will hit the floor, leading to less spending and a deeper recession. Plus, credit could dry up, making it tough for families to get loans for basic stuff like buying a house or car. In short, the effects will touch everything: retirement, housing, jobs, everyday spending, just like past financial crises, but very likely much more worse in a war between the CCP and the U.S. So, how could all this go down? 2 words: chips and dominoes. And no, I'm not talking about snacks or pizza here. Believe it or not, Taiwan is the semiconductor superpower of the world. It produced 60% of all chips globally, and an astonishing 90 to 95% of the most advanced chips. Top one, better one, cutting edge ones, just like the ones used in AI. Taiwan Semiconductor Manufacturing Company, TSMC, we talked about that in our first episode, making 90% of NVIDIA's in-demand AI chips. It's an undisputed leader and far ahead of Intel and Samsung. And it's not just NVIDIA. These chips are everywhere, in Teslas, Ford Lightnings, RAV4s, CRVs. Basically, almost every car has those chips. And they're also in iPhone 16, Samsung Galaxy, OnePlus watches, all the consumer electronic gadgets. By some estimates, TSMC alone produced 70% of smartphone chipsets and 1/3 of the world's car microcontrollers. Tech giants or startups, everyone relying on those chips. Goldman Sachs estimates that 190 industry, almost 170 industry, depend on chip made in Taiwan. From automotive, finance, consumer tech, a 10% chip shortage alone can cost car companies $200 billion in revenue. Now imagine losing an entire year's supply. Tech companies could face $600 billion in losses, effectively stopping the global electronic supply chain. According to the Rhodium Group, another great research firm. Industry like automotive, smartphones, PCs, and servers could collectively lose up to $1.6 trillion annually. $1.6 sales revenue, $1 trillion annually. Sure, Intel, AMD, TSMC are working on building chip plants in the US, but it's going to take years and hundreds of billions of dollars just to achieve a small fraction of Taiwan's current capacity. Now here's the truly dangerous part. All of TSMC's fabs, the fancy name for the chip-making plants, are on Taiwan's west coast, facing mainland China. Many are located near red beaches. It's a military term for likely landing zones for the CCP troops if they were to invade Taiwan. The company's headquarters and its massive chip-making cluster in Hsinchu, it's a city in Taiwan, just 7 miles from the coast. They are right in the line of fire, and they're almost defenseless. Now let's talk about the domino effect. It's a chain reaction that could shake the global economy. Insights from the Rodion Group and the Wall Street analysts highlighted how a CCP-U.S. war could kick off massive disruptions. Think beyond just a chips shortage. We're talking about global shipping going haywire, trade collapsing, supply chains breaking down, investments drying up, and the money flows stop. And that's all before we even get to the impact of sanctions. The ripple effect here, it's going to be truly catastrophic. The Taiwan Strait, right, is like the highway for nearly half the world's container traffic, and 80% of the biggest ships out there. If there's a war, the route is toast, completely blocked. Rerouting through places like the Philippine Sea would mean major delays, and that's even worse during the typhoon season. On top of that, trade financing, the loans which importer and exporter rely on and supports about 1/3 of global trade, would take a huge hit. Imagine you're selling a car for 20 grand, but the buyer wants to pay you over time. You need a cash now. What can you do? With trade financing, you can sell the invoice to a finance company for, say, 19 grand, so you get your money immediately, cash immediately, and they collect from the buyer later. That's like a getting paid now without waiting, and that's going to help your business running smoothly. But in the case of a war, banks, finance company, they're going to pull back, scared of sanctions and the defaults. Without their financing, buyer, seller will have to cut back the deals and transactions. This would choke the global flow of goods. For comparison, during the 2008 financial crisis, reduced the financing cost almost 20% of the drop in global trade. A Taiwan conflict could hit much harder. On top of losing 2/3 of the world's semiconductor production, we're looking at losing over half the global steel supplier, not to mention a big chunk of other commodities. That would mean shortages of essential raw materials and the parts, throwing industries into chaos left and right. This isn't just about high-tech companies. It's going to affect everything from medical devices to telecom gear and agriculture and mining equipment. Even basic infrastructure and vital goods would also feel the squeeze, putting immense pressure on economies and the supply chains everywhere. Inflation would spike across the board, especially early on. While some prices might dip because of the following recession, a lot of the others could stay sky high due to ongoing shortages. Chip prices might jump by 20 to 50%, making gadgets 10 to 30% more expensive. Oil could spike over $150 a barrel for a bit. It may fall back if China's demand tanks with its economy, but the impact wouldn't stop there. It'll hit essentials like the food and the farming, making everyday life a lot more expensive. Foreign investors are likely to dump Chinese assets big time to avoid sanctions and the risks. We could see Chinese stocks and the yuan, the Chinese currency, tank, dropping way faster than the Russian market and the ruble did before they invaded Ukraine. This could destroy hundreds of billions in investor value and might push the CCP to clamp down even harder on capital controls, basically locking funds inside of the country. Foreign companies in China, especially in auto manufacturing and tech, are going to take hits, big hits from disrupted trade, boycotts, and a capital flight. The CCP might even nationalize, it's a fancy word for confiscate, take away foreign assets for put stops on companies trying to take their profits out of China. And the risks we're talking about could completely change how global investments and operations work in China. TSMC and NVIDIA are right in the middle of this storm. TSMC being the world's leading chip maker, and NVIDIA, which relies on TSMC's cutting-edge manufacturing for advanced chips, are particularly at risk if there's any trouble in the Taiwan Strait. Okay, on top of that, there are many other companies that are exposed to China. We recently pulled together a list of companies with the highest percentage of revenue coming from China. It's no shocker that semiconductors and tech companies dominate the list. But what's interesting, 2 casino and hotel companies also made the cut. Let's take a look. Las Vegas Sands, LVS. These guys have a massive presence in Macau, the place they called Las Vegas of the East Asia. They own 5 major casino hotel spots there, each one like a mini city with replicas of Venice, London, and Paris. They've dumped billions into renovating those places, like $2 to $3 billion. And they're not just in Macau. And they've got operations in Singapore too, which also pulls in a lot of Chinese tourists. When you look at how they're doing in the U.S. versus Asia, it's clear where the money is at. The bulk of their revenue, if not all, we're talking about $11 billion, with $1.5 billion in net income, comes from their China-related business. That's a massive, massive exposure right there. You know how some people often say the stock market always bounces back? Sure, look at the S&P 500 or NASDAQ. They've hit all-time highs, even after the dot-com bubble or the financial crisis. But here's the thing. That's just for the indices. For individual stocks, not so much. A lot of them tanked, went bankrupt, and gone forever. And some, well, they just never make it back to where they were. Take a look at the Citigroup, the big bank. Its stock price totally collapsed during the financial crisis. They've gone through all these restructurings, and where are they now? It hasn't recovered even 20% of its former glory. That's right. Not even a fifth of what it used to be. Man, did you know that during the 2008 and 2009 financial crisis, LVS stock plummeted by 95%. And it's taken them 16 years just to recover only half of what they lost. So if you're keeping an eye on LVS, watch out, huh? Next one, Qualcomm. They're huge in telecom and tech, powering billions of devices with their processors, and they're pushing forward with AI, 5G, and the connectivities. But here's the thing. They've got a lot riding on China. We're talking about almost 63% of their revenue, which was like $22 billion back in 2023, coming from there. That's a bit worrying, right? Although they're trying to diversify, aiming to get that dependency below 50% for 2024. And a big chunk of that revenue comes from selling chips and mobile tech with strong ties to companies like Huawei, Xiaomi, Oppo, and Vivo. all of whom rely on Qualcomm's chips for their gadgets. Another one to look out. So now there is Monolithic Power Systems, MPS, another U.S. semiconductor players, ranking third with about a little over half of its revenue, which is around $1.2 billion coming from China, plus another 15 to 16% from Taiwan. That's like a double whammy. This is mainly from selling those power management chips that are super important for cars, industrial, telecom, cloud computing sectors. If you've got MPS in your portfolio, you better keep a sharp eye on it as well. Here comes Western Digital, at number 4. They are the ones behind those portable hard drives you might have seen. They're pretty exposed to China as well, with $5.3 billion, making up about 43% of their sales. Coming from their storage products, think hard drives. There's a big demand for these in China, in everything from consumer gadgets to cloud storage to manufacturing. China is a big deal for Western Digital too. Then there's this other big casino and hotel company, Wynn Resorts, coming in at number 5 on our list. That gets about 40% of its revenue, which is around $4.2 billion from Macau. They are huge in luxury gaming, fancy hotel rooms, gourmet dining, and entertainment scenes down there, all of which depend a lot on Chinese tourists and business folks. Now here's a quick rundown of the next 5 companies with significant exposure to China and not as much. First one, NXP Semiconductors. Around 1/3 of its revenue, $4.5 billion, comes from China, mainly from automotive chips sold to Chinese car companies. Broadcom, 32% exposure, $11 billion, providing semiconductors for networking, broadband, and mobile phones. Applied Materials, 27% of its revenue, $7 billion from China, with an additional 21, $5.6 billion from Taiwan. They sell equipment and software for semiconductor manufacturing. Lam Research, 20% China exposure, 10% Taiwan exposure, generating $4.6 billion, primarily from providing wafer fabrication equipment to Chinese chip makers. IPG Photonics, 28% exposure to China, specializing in high-performance fiber lasers used in industrial automation, manufacturing, and telecommunications. Now, we've also put together a list of the next 20 companies that have a good chunk, though not as much, of their business tied up in China. We don't have time to go through all of them, but do yourself a favor and save this video. Add these companies to your watch list. The CCP and the U.S. war over Taiwan could definitely shake things up for them. So, to sum it up, a war involving the Chinese Communist Party could hit the global economy by $10 trillion and some, potentially causing 3 to 4 times of that in stock market losses, with hundreds of major companies facing collapse. On top of this, we will face the tragic loss of countless human lives. I gotta say, I don't really enjoy talking about these scenarios, and I really hope we never see it happen. But it's important for us and help you to be aware and get ready just in case. There's a genuine possibility or even probability this could all go down. And in our next episode, we're going to get into the nitty-gritty, the details of how likely it actually is. If you found our video helpful, please consider subscribing, liking, and sharing. See you soon.